Today we're going to take a look at chapters 4 and 5. Both of these have to do with inventory, just different aspects of the inventory. Chapter 4 focuses a little bit more on cost of goods sold, journal entries, introduction to that information. And then chapter 5 will focus on the actual amounts for inventories and cost of sales. So a couple of T accounts that I'd like to let you know about. First one is merchandise inventory. This is an asset account, and it's going to increase with a debit and decrease with a credit. We also have cost of goods sold. This is an expense account. Increases with a debit, decreases with a credit. Now we're going to start focusing on merchandisers. And merchandisers typically will earn net income by buying and selling merchandise. They could be a wholesaler or a retailer, but overall, that's the way that they earn their income. Generally, when we report income for a merchandiser, it looks a little more detailed than our previous service companies. As you can see down here, merchandisers typically have net sales, and we subtract out the cost of goods sold to get a gross profit. Then we subtract out all the other expenses and get a net income. This is an example of what the service company income statements look like for you before, and this is a merchandising company one now, where you see the net sales minus cost of goods sold equals gross profit minus expenses equals net income. You would still come to the same net income. However, in this scenario, we are looking at a new level of profitability. So overall, general calculation for gross profit, which is also called a gross margin, is just going to be net sales minus cost of goods sold. You're going to see me write COGS for cost of goods sold for the most part. And down here, cost of goods sold is calculated in general by taking beginning inventory plus any purchases that were made minus ending inventory. Turning the page. Here we go. Next up, we're going to use the following information from a merchandising company, not also from a service company, so I'm going to cross that out, to complete the following requirements. So we have Safeco Merchandiser, and they have supplies of $10, beginning inventory of $100, ending inventory of $50, expenses of $20, net purchases of $80, and net sales of $190. For the merchandiser only, we will compute the goods available for sale, the cost of goods sold, and the gross profit. Parts of these kind of go into each other in terms of the goods available for sale can be calculated while calculating cost of goods sold. So I'm going to put together the cost of goods sold, and I'll point out to you where we have that goods available for sale. We're going to start with beginning inventory. And we're going to add in net purchases. This is going to give us our goods available for sale. After that, we'll subtract out ending inventory. And that's going to give us our cost of goods sold. So beginning inventory was 100, net purchases were 80, so the goods available for sale is 180. Then we subtract out our ending inventory, which was 50, and we get cost of goods sold of 130. Finally, to get our gross profit, we're going to take net sales. We're going to subtract out cost of goods sold, and that will give us gross profit. So net sales is 190, cost of goods sold is 130, so we get a gross profit of 60. Now we're going to start to look at inventory a lot more through these chapters. An important thing to know, and you're going to look at this again when you get into chapter 5, is that your net purchases plus your beginning inventory is all the merchandise that's available for sale. At the end of the period, there are two places that can go. It can stay in your ending inventory, or it was sold, and it's going to be cost of goods sold. There are going to be two main inventory systems that we're going to use. These will impact journal entries, and they'll impact how we determine the cost of things like cost of goods sold when we get into chapter 5. First up is the perpetual inventory system. This system records costs of goods sold at the time of each sale. Next up is the periodic inventory system. In this one, we record cost of goods sold at the end of each period. Turning the page. Now, we will start to look at merchandise purchases. In terms of some additional information you need to know for purchases in terms of transportation costs, is this thing that we call FOB, which counts as free on board. And this is going to be the point of transfer. And what it basically means is who's responsible for paying shipping costs and who bears the risk of loss during a transit for merchandising transactions. So if FOB is at the shipping point, the point of transfer is at the shipping point, the ownership transfers at the shipping point. If that's the case, the goods in transit are owned by the buyer. That also means the transportation costs are paid by the buyer. If it's FOB destination, that means ownership transfers at the destination. That means the goods in transit are owned by the seller. And the transport costs are paid by the seller. Now we're going to look at some different merchandise purchase examples, and we're going to record the journal entries for each of these transactions. We're assuming a perpetual inventory system using the gross method for recording purchases. First up, on October 1st, we purchased $1,000 worth of goods. The terms of the sale are 410 and 30, and FOB shipping point. The invoice is dated October 1st. For the terms, the 410 and 30 means 4% discount if paid in 10 days. Otherwise, the net is due in 30 days. So for the purchase of the actual inventory, October 1, we're going to debit merchandise inventory, $1,000, and we're going to credit accounts payable, $1,000. Next up, on October 3rd, we paid $30 in cash for freight charges from UPS for that October 1st purchase. This is because it was FOB shipping point, which means the ownership transferred to us at the shipping point. So we're responsible for the cost of the transit, okay? So on October 3rd, we're going to debit merchandise inventory for $30, and we paid cash, so we're going to credit cash $30. On October 7th, we returned $50 of the $1,000 of goods from the October 1st purchase and received full credit. So on October 7th, we're going to debit accounts payable for that $50, and we're going to credit merchandise inventory for $50. Finally, on October 11th, we pay the amount due from the October 1st purchase minus the return on October 7th. We're also paying this in 10 days. So we get to take advantage of that discount. Now let's look at our accounts payable account. Originally it was $1,000, but we reduced it by 50. So now it's $950. So on October 11th, we are going to debit accounts payable $950. We're going to credit merchandise inventory for the discount amount. So we're going to take $950 times 4%. We're going to get 38. And then the difference will be cash. And that'll be $912. Turning the page. Now we're going to look at merchandise sales. When we use the perpetual inventory system, we will have two entries basically when we record a sale. One will be the revenue recorded, where we increase the asset, and that's recording revenue from the customer. And the other entry will be the cost of goods sold incurred to the customer. Okay, so we're going to look at some example entries for merchandise sales down below. We'll prepare journal entries to record each of the following transactions: perpetual inventory system, and they gave us a detail on beginning inventory. But on June 1st, we sold 50 units of merchandise inventory to a customer for $150 per unit under credit terms of 210 and 30, so 2% discount if paid in 10 days. Otherwise, net due in 30. FOB shipping point, and the invoice is dated June 1st. The 50 units of merchandise had cost $100 per unit. So there's going to be two entries here. The first one's going to be for the revenue. We're going to debit accounts receivable. We're going to take 50 units times 150. We're going to get $7,500. We're going to credit sales revenue. Then their secondary entry will be for the cost. We're going to debit cost of goods sold. We'll take the 50 units times $100. And we will credit merchandise inventory. On June 7th, the customer returns 2 units that were purchased on June 1st because those units did not fit its needs. The seller restores those units to the inventory, they're not defective, and credits accounts receivable from the customer. So this is also going to involve two entries. June 7th. The first will be for the return. We're going to debit sales returns and allowances. We've got 2 units at 150, so it'll be 300. And we're going to credit accounts receivable. And then the secondary entry is where we're going to return it to our inventory. We're going to debit merchandise inventory, 2 units at 100. We're going to credit cost of goods sold, 200. Next up, the seller receives the balance due from the June 1st sale minus any returns and allowances. So we will determine what our accounts receivable looks like. Initially, we debited it $7,500, but then we credited it $300. So the balance is $7,200. June 11th is also within the discount period. So what we'll be doing is we'll be collecting cash, and we will be debiting sales discounts. Let's start with the sales discount. 7,200 times 2% discount is going to be 144. Our accounts receivable is 7,200. We'll take the 7,200, we'll subtract out the 144. The actual cash received will be 7,056. Later on, the customer discovers that 10 units have minor damage, but they keep them because the seller sends a $50 cash payment allowance to compensate. If we are the seller on June 14th, we're going to debit sales returns and allowances. For $50, we're going to credit cash for the cash payment of $50. Turning the page. At the end of the period, we need to make some adjusting entries. In addition to the adjusting entries that you've already learned, we're just learning a new one, which accounts for inventory shrinkage. Additionally, we're going to look at the closing entries and how they involve these new accounts that we have in this particular chapter. So in this example, we have a merchandising company whose ledger is as of May 31st. This is their fiscal year end. It includes the following accounts that have their normal balance and uses a perpetual inventory system. Physical count of its May 31st year-end inventory reveals that the cost of merchandise inventory still available is actually $656, so $100 difference. So we're going to record the entry for that inventory shrinkage. On May 31st, we're going to debit cost of goods sold. $100, and we're going to credit merchandise inventory $100. So now our merchandise inventory is going to be $656, and then our cost of goods sold is increased $100 to $2,200. We're going to need that cost of goods sold updated so that we can do the closing entries. Our closing entries look very similar to how they looked in Chapter 3. Main difference is we have a few new account names that I will put in red. So we'll start out and we will close out basically our credit balance for sales. So May 31st. Sales normally carries a credit balance, so we're going to be debiting sales $4,300, crediting income summary $4,300. The next entry is where we will close out the debit balances. So May 31st. The debit will be income summary. We'll total up all the other balances before we get to that one. Some new account names we'll have: sales discounts. It's being credited $50. Sales returns and allowances. Is being credited $250. I'm going to scoot this up. Cost of goods sold is being credited now $2,200. And the remaining ones are all expenses that you were used to seeing. So I will do depreciation expense. That one's $400. I have salaries expense. That one is $600. And I have other operating expenses. That one's $300. Totaling all these up, income summary will be debited $3,800. I'm going to scoot this back down just so that we can update our income summary T account so that we know what to close that out for. We credited the account $4,300. We debited it $3,800. So our ending balance here is going to be 500. I'm going to close out the income summary account now. May 31st. Debit to income summary. 500. Credit to retained earnings. 500. And then finally, our last one is where we close out the dividends. May 31st. Debit to retained earnings. 150. Credit to dividends. 150. Turning the page. Next up, we're going to take a look at the multiple step income statement. These are just the accounts that I'll be using on the next page. This is the adjusted account balances from the general ledger on April 30th. And we're going to utilize what we need for a multiple step income statement. Multiple step income statement is just going to have different levels of profitability, and I'm going to show you how to put that together. So using the information from the previous page, I'm going to prepare a multiple step income statement. We're going to start with our sales, determine what our gross profit looks like. Then we go through operating expenses that are going to be separated into selling and general and admin expenses, and I'll give you some tips on that as well. So first up, we're going to start with sales. The sales amount was $9,500. Next up, we're going to reduce by a couple things to get our net sales. We'll reduce out the sales discounts and the sales returns and allowances. So sales discounts was $260, and sales returns and allowances was $240. We'll add those two together, we'll get $500. We'll subtract them out from sales, and that will give us net sales. So we're at $9,000. Next up, we're going to subtract out cost of goods sold. Cost of goods sold was $6,500. Net sales minus cost of goods sold will equal gross profit. So 9,000 minus 6,500 will be 2,500. Next up, we move into the operating expenses. To start to prepare you for managerial accounting, they do have you separate these into selling expenses and general and admin expenses. My tip for knowing whether it's selling expenses or not is if it involves the salespeople, in terms of where they sell or them selling, or if it involves advertising, those are part of selling expenses. Everything else that takes place in the office is an office general admin kind of expense. So we'll start with selling expenses. The selling expenses that are involved here include sales salaries expense, and that's $450. And then we have rent expense for the selling space. That's $400. And then we have the store supplies expense. That's $30. And we have advertising expense. That's $20. We're going to total these up and get our total selling expenses. And that'll come out to $900. Next up will be our general and admin expenses. This includes office salaries expense, which is $420. Rent expense for the office space, that's $72. And office supplies expense, and that's $8. Below that, we'll get our total general and admin expenses. Scooting that up. This is $500. Below that, we'll total up our operating expenses. Which is $900 plus $500, or $1,400. Finally, down below that, we'll calculate net income. We'll take gross profit of $2,500 minus operating expenses of $1,400 for net income of $1,100. Turning the page. Now we're on to chapter 5. This one focuses on more of the costs of inventories and costs of sales. When we discuss what merchandise inventory includes, it's going to be all goods that a company owns and holds for sale. This is going to be regardless of where the goods are located when the inventory is counted. Now, as a reminder, we had 2 free on board goods in transit points. First one being FOB shipping point. On the FOB shipping point, the point of transfer is when it ships. And then FOB destination, the point of transfer is the destination. Some new things as well. Goods on consignment. A consignor is an owner of the goods. The consignee sells the goods for the owner. When determining who holds on to the inventory, the merchandise is included in the inventory of the consignor. Consignees never report consigned goods in their inventory. Additionally, goods that are damaged or obsolete. If the damaged goods cannot be sold, they are not reported in inventory. If the damaged items can be sold, they are included in inventory at their net realizable value. A loss is going to be recorded when damage or obsolescence occurs. Now, when we determine an inventory cost, typically this is going to involve invoice cost minus any discounts plus other costs. And other costs can include things like shipping, storage, insurance, and import duties. Turning the page. Now we're going to talk about inventory costing methods. There are going to be 4 main methods that we use. They will determine on perpetual or periodic in a couple of them, but the 4 methods, I guess, that we'll use is going to include specific identification, first in, first out, last in, first out, and weighted average. With the exception of specific identification, the physical flow and cost flow do not have to be the same. And our inventory costing is going to affect two places: balance sheet ending inventory, and income statement cost of goods sold. Some additional notes on these: specific identification is used when the inventory item, when each item in inventory can be matched with a specific purchase or invoice. Some examples of this might be something like jewelry or cars. Typically, this is going to match the cost of the items with the revenues they help generate, which is considered a big advantage. Next up is first in, first out, and this is an assumption. They assume that inventory items are sold in the order they are acquired. So when sales occur, the cost of the earliest units that were acquired are going to be charged to cost of goods sold. Advantages to this include inventory on the balance sheet will reflect current cost, and it follows the actual flow of the costs. Last in, first out is also an assumption. In this one, the most recent purchases are sold first. Scooting that up. In LIFO, the more recent costs are charged to cost of goods sold, and the cost of the earliest purchases are still assigned to inventory. Advantages to this are that cost of goods sold on the income statement would reflect a current cost and better matches current costs with revenues. Finally, we have weighted average. And weighted average, which is also called average cost, requires that we use a weighted average cost per unit of inventory at the time of each sale. Advantages to this one include that it will smooth out erratic changes in costs. Now we're going to look at some examples. We have Abdel's Electronics Store and reported the following information for December. We've got purchase and sales data. We're going to utilize this information to determine things like cost of goods sold and ending inventory related to specific identification, first in, first out, last in, first out, weighted average. We're going to be using both periodic and perpetual inventory system. Up here, just note that right now we're doing periodic. Okay, so details that we have: on December 1st, there was beginning inventory of 5 units. We made a purchase of 10 more on December 8th. On December 9th, we sold 8 units. On December 19th, we purchased 13 additional units. On December 24th, we sold 18 more units. And on December 30th, we purchased 8 more units. Total units available for sale is 36. Total cost of these is $167.40. Total units sold is 26, which means ending inventory will be 10 units. We're going to utilize this information and we're going to put it into all of the different methods. So when I'm adding this information into each of the charts, just know that it's all coming from the same information on this page. So first up, we're going to start with specific identification. The cost of goods available for sale section is already filled in for you. 36 total units available, total cost of $167.40. We're going to determine the cost of goods sold in the ending inventory based on specific identification. And using this info, it says ending inventory consists of 10 units. And we know we sold 26, so we'll do that too. 8 are from the December 30th purchase. So we'll put 8 in the December 30th section. And then we have 2 from the December 8th purchase. So we go December 8th and we have 2. So our ending inventory has 2 from December 8th, 8 from December 30th. The remainder is going to be in our cost of goods sold. So we'll start with beginning inventory. There were 5 units available. If none of them are in our ending inventory, all 5 will be in our cost of goods sold. December 8th, we had 10 units available. 2 are in our ending inventory, which means 8 were sold. December 19th, we had 13 units available for sale. None in our ending inventory, so 13 were sold. And finally, December 30th, we had 8 units available. 8 were in our ending inventory, so none were sold. Now we're going to calculate the cost of goods sold in the ending inventory based on this information. So for cost of goods sold, I had 5 units in beginning inventory, and their cost per unit was $3. So it's going to come out to $15. Next up, we had 8 units for cost of goods sold at $4.50 a piece. That's going to come out to $36. And then I have 13 at $5 a piece. And that's going to be $65. None here. So we're just going to add down this column to get our total cost, which is going to come out to $116. And then we're going to do the same thing for ending inventory. 2 units that were acquired at $4.50 a piece is going to be $9. 8 units acquired at $5.30 a piece is going to be $42.40. We add down this column, we'll get our total cost of ending inventory, which is $51.40. Turning the page. Now we're going to do first in, first out with periodic. Same info. We still sold 26 units. We still have 10 in our ending inventory. In first in, first out, we go chronologically down the line until we hit 26. So we start with beginning inventory of 5. We move on to December 8th, and that's 10. We have 15 units accounted for, which means we need to account for 11 more. So when we get to December 19th, 11 of those are going to be in our cost of goods sold, and the remaining 2 will be in our ending inventory. Also, the December 30th, all 8 will be in our ending inventory. Now we calculate it out. Beginning inventory, 5 units purchased at $3 a piece is $15. 10 units that we acquired at $4.50 a piece is $45. 11 units that we acquired at $5 a piece is going to come out to $55. Our cost of goods sold gets added up. We get $115 here. Then we move on to ending inventory. 2 units acquired at $5 a piece is $10. And 8 units acquired at $5.30 a piece is $42.40. Our total cost here will be $52.40. That stays in our ending inventory. Chronologically, you work through it with FIFO. Now, LIFO and weighted average will be different depending on whether they're periodic or perpetual. Specific identification and FIFO are the same in either of those aspects. But LIFO for periodic, it will matter if it's periodic or if it's perpetual, and same with weighted average. Right now, we're going to look at LIFO and periodic. Okay? With LIFO periodic, we use the assumption that we start at the very last purchase and we work our way backwards chronologically, no matter when the items were sold. Okay? So we're going to know that we sold 26 and we have 10 in our ending inventory. We're going to start at the bottom this time. We have 8 units. So we move on and we continue to add. We have 13 here. So now we are at, 21. We need 5 more out of this one to reach our 26. The remaining 5 from that are in our ending inventory, and the beginning inventory of 5 are also in our ending inventory. Calculations. We have 8 that we acquired at $5.30, for $42.40. We have 13 we acquired at 5 for $65, and we have 5 we acquired at $4.50 for $22.50. Add these up, you're going to get $129.90 for your cost of goods sold. For ending inventory, we have 5 that we acquired at $4.50 for $22.50, and 5 that we acquired at 3 for $15. Add these up to get your ending inventory, and it's $37.50. Weighted average is also different for periodic. With weighted average, we get to just use all of the information from the period to determine that weighted average per unit cost. So what we will do is we're going to take our total cost of inventory, which was $167.40. We're going to divide it by the total units available, which was 36. And we're going to get $4.65 per unit. To determine our cost of goods sold, we take 26 units times $4.65. We get $120.90. To determine our ending inventory, we take 10 units times $4.65 to get $46.50 in ending inventory. Now, this does not look the same when we get to perpetual for LIFO or for weighted average. Those two are periodic that you're seeing right now. I'm going to turn the page. Now we need to look at LIFO and weighted average regarding perpetual. If they tell you perpetual for specific identification or for first in, first out, the numbers will be the same. Perpetual impacts LIFO and weighted average because in perpetual inventory systems, we're using the most recent purchase information. So the chronological order in which we go will matter, okay? So in this particular one, when we're looking at the inventory balance, we're going to have like an amount per unit and kind of just keep tabs on the inventory balance, okay? So on December 1st, this is just your beginning inventory. You had 5 units at $3, which is $15. On December 8th, we purchased 10 units at $4.50 for $45. So now our inventory has 5 at $3 and 10 at $4.50 for a total of $60. On December 9th, we sold 8 units. We're going to look at our most recent purchase in last in, first out and use those items first. So 8 of those come from this most recent purchase of $4.50. That'll be $36. Inventory balance. We still have 5 at $3, and now we have 2 left at $4.50, giving us a total of $24 over here. Continuing on. December 19th, we made another purchase. We purchased 13 units at $5 a piece for $65. Over here, inventory balance. We had 5 at $3, 2 at $4.50, and now 13 at $5. Total inventory available for sale right now is $89. Moving forward, on December 24th, we sold 18 units. We're going to start at the end and work our way backwards. I'm just going to put up here 18 units. So we'll start with the 13 at $5, which is $65. And then we have 2 at $4.50, which is $9. And then we have 3 at $3, which is also $9. In total, this is $83. What we have left in our ending inventory is 2 at $3, which is $6. Finally, on December 30th, we purchased 8 more units at $5.30 for $42.40. Oops. So ending inventory, 2 at $3 and 8 at $5.30. In total, we've got $48.40 in our ending inventory. This is going to be your ending inventory balance. And I'm going to put down here, cost of goods sold is going to equal 36 plus 83. That's going to come out to 119. But your ending inventory balance is already calculated for you in that ending inventory balance on December 30th. This is LIFO perpetual. Weighted average also has some extra work to it. We'll look at that in a second. In weighted average, we have to come up with a new weighted average every time we make a new purchase. Okay. So on December 1st, our beginning inventory was 5 units at $3 a piece, which was $15. Weighted average right now is $3 per unit. On December 8th, we bought 10 more units at $4.50 for $45. Inventory balance is going to be 5 at $3 and 10 at $4.50. In total equals $60. And we're going to take basically 60 divided by 15. And our new weighted average is going to be $4. On December 9th, when we sold 8 units, we're going to take that $4 weighted average, and it's going to be $32. Right now, we have left, we had 15. I'll put right here 15. We had 15 units. We subtract out 8, and now we have 7 units at a $4 weighted average, which is $28. Still $4 weighted average. Next up on December 19th, we purchased some more. We purchased 13 units at $5 a piece for $65. So we had 7 times 4 equals 28, plus 13 times 5 equals 65. The total here for those is going to be $93. So we're going to now take 93. We're going to divide it by 20 units. Our new weighted average will be $4.65. Scooting this up. On December 24th, we sold 18 more units. We'll sell them at the $4.65. That'll be $83.70. That leaves us 2 at $4.65. Our weighted average is still $4.65. December 30th, we purchased 8 more units at $5.30 a piece for a total of $42.40. So now we have 2 at $4.65 and 8 at $5.30. The total of this inventory is $51.70. So we take $51.70, we divide it by 10 units. Our new weighted average is $5.17 per unit. That would be our weighted average going forward. We do have to adjust the weighted average every time we make a purchase in this. All the way down here at the bottom. I apologize. In total, our cost of goods sold is 32 plus 83.70. That'll come out to 115.70. And our ending inventory is 51.70. Turning the page. Finally, we have lower of cost and market. Inventory needs to be reported at market value when the market value is lower than the cost. This is defined as a current replacement cost and not a sales price. So it can be applied in 3 separate ways. One, separately for each item. Two, to major categories of assets. Or 3, to whole inventory. We're going to look at an example. We have Auto Adrenaline, and they provide specialty car products. They have satellite radios, GPS navigation systems, and subwoofers. And at the end of the year, the company's records show the following amounts in ending inventory. So we have the quantity, the cost per unit, and the market per unit. So we're going to calculate the ending inventory, which is lower of cost and market value. And I'm going to build just kind of like a table here. I'm going to put item, I'm going to put quantity, I'm going to put cost per unit, I'm going to put market per unit, I'm going to put total cost, total market, and LCM, which will be lower of cost and market. So we've got satellite radios, we have GPS, we have subwoofers. We'll start with satellite radios. We have 10 of those, and they cost $100 per unit, and market is $120 per unit. If I take my 10 times the cost, I get a total cost of $1,000. If I take my 10 times the market, I get total market of $1,200. The lower of these two is my cost. So for my lower of cost and market, I just put the lower number. In terms of the GPS, I have 20 units that cost $300 a piece and have a market of $350 a piece. I take the 20 times the cost, so 20 times 300, I get $6,000 for total cost. I take the 20 times the market, so I get a total market of $7,000. I'm looking for the lower of the two here, so that's going to be total cost. I put that under low of cost and market. Finally, for the subs, we have 40 of them. They cost $70 per unit. Market is $50 per unit. To get my total cost, I take quantity times cost per unit. I get $2,800. To get my market, I take 40 times 50. I get $2,000. Lower of cost and market on these ones is the market. I put $2,000 here. I need a couple totals, one of them being total cost, which is $9,800, and the other being lower of cost and market, which is $9,000. That difference there needs to be the journal entry that I need to make. So the year-end adjustment, when lower of cost and market is lower than total cost on December 31st, is going to be a debit to cost of goods sold. The difference here is $800 and a credit to merchandise inventory.